You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. Today on The Biz, our foray into the single premium life market, the next new wave of life insurance products with senior marketing expert Michael Simpson.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, senior market expert Michael Simpson. Welcome to the show, Michael.
Thank you, Steve. Nice to be here.
You know, I back in the day, now if you've been as long as I've been in this business, 30 years, single premium life was the mantra product. You could put money into a policy. You'd only have a 10 or 15% extra death benefit on top, so you only paid the net amount at risk. We were getting double-digit returns, and young people, if you weren't around by then, I have to tell you, we were able to take that money out tax-free. But TAMRA came in online at 6/21/88. And when TAMRA came online in the Technical Corrections Act, it changed the game. And now, of course, any contract that's a life insurance policy that's a single deposit is going to be a modified endowment contract. Now, normally I would say, okay, fine. If you have no money to really burn in a CD because we're not getting any rates there, if you have nothing for money markets, you might as well put it in life insurance just to get the leverage because you're actually making a little bit more. But now the whole market is so changed that we're adding morbidity riders to this. We have tax plays on this now. We have leverage. We have second to die in this game. I mean, there's so much that's happened. So Mike, let's just talk about it. Let's give an introduction to the market because I think a lot of people thought that this kind of died 20 years ago. It has some flavor, it has a little bit of leverage, but no big deal. But actually, really, we have a lot of annuity guys making the migration over to this area.
We really do. The big deal is to not consider just the annuity for tax deferred or insuring the principal. If a client doesn't need the income, and where else are they going to look for? They're going to look for mutual funds for growth or CDs for, again, growth, but yet preservation. The big deal is, where am I putting my money today as a senior? Single premium life, every agent ought to consider a simplified issue, single premium life.
So now when you mean simplified issue, I know that's great. It's not full underwriting.
No, it's not.
So but when you're talking about it, what do you mean by simplified? No pee in the bottle, there's no blood drawn. What do I get for
There's
that?
a lot of product out there and a lot of different underwriting type introduction for the client to get them through the approval rate. But here's what we're looking for is no paramed, no blood, urine, physical exam, a quick decision, either on a phone interview, an MIB, it may be an APS, but certainly in short order, 3 days or less, an underwriting decision.
We're going to know.
We're going to know.
Now, this is where a lot of this is being sold in the senior market, isn't that so?
Always. 65 to 85 is the market.
So that is the market.
65 to 85 is the market.
So when people, how's the underwriting on a lot of these carriers? I mean, when you get past 65, we are doing simplified, underwriting, so we're not getting all the information.
Right.
How benevolent are the underwriting and are the carriers on this?
Well, a lot of them are generous. There are some that offer long-term care or more with the ABRs, if you will. And those are going to have more morbidity type of underwriting versus the mortality. And we're looking for mortality if you're,
Well,
if you're
let me
trying
stop you there just for a second. So if I had a true single premium life contract that didn't have the morbidity riders on it like LTC, chronic illness, anything like that, if that was just a standalone mortality play, that's going to be a lot cleaner in the single premium life part.
Absolutely.
But now the moment I join LTC riders to it, then I'm going to go into morbidity underwriting, right? I mean, and I'm going to have to look at that. Have you seen that as a takeaway? Has it been much? I mean, are they really liberal on that side of the fence?
If you see the riders, you're going to see some restriction on who's coming through the other side on approvals. But there are products out there that base their ABRs on death benefit. In other words, there's not a roll-up on long-term care in advance, like put 100 grand in and get $300,000 in long-term care. There are some out there that base their long-term care, home health care, assisted living on the death benefit. And because they're underwriting on net amount at risk in that factor, or the morbidity, then we're talking about a whole different matter here.
What kind of death benefit am I getting? When I get to 65, simplified issue, I'm assuming that their standard boilerplate. I mean, we're not. There's no preferred. I mean, it's just one big standard category. Probably going to table 4. I mean, what are we looking like? Is it 2-to-1 ratio on death benefit for dollars spent?
It's going to be less than that, but here's the one consideration. If you're the agent, you're always looking out for the best bang for the buck or punch for the client. Always put them first. But if you've got a 65 to 70-year-old folk, or maybe even up to 75, that has no pre-existing conditions or a clean health rate, then you could push them through fully underwritten. That's the way to really go. Because you could take a fully underwritten life insurance, UL, whole life, and do a single premium on it. We can run illustrations for that. But if you're looking for someone who's got, might be a table 4, been declined or rated by another carrier on fully underwritten, then look for the simplified issue, because they're going to go table 4, banded underwriting, or up to table 8, up to a certain age, like age 80, as an example.
How old do they go all the way out if you're decent health?
All the way out to age 85.
Okay, now and that's single life. What about second to die? The same?
Well, second to die is a combination or a median age of someone maybe 90 who might be 83 as a
so
spouse.
the person could be actually 90 as long as the median age of both clients are what age?
On a survivor. Again, under age 85. Max
Under
age 85.
Gotcha. And now, do you see much of that? Because that would tell me, I think you get a lot more leverage out of second to die then.
You absolutely do. If, again, long-term care is not the play. If the client's looking for long-term care as an alternative, doesn't have it, can't afford it, can't qualify for it, you're looking for it through a life insurance carrier, then obviously, survivor's not the way to go.
So if I have a pretty healthy client, I still want to fully underwrite this, because I've seen, I wouldn't call them true single premium life, it's just, here you have a single deposit into a really good contract.
That's right.
You might want to look at that. But if you've got issues, and if you just want to be able to turn the key, maybe the client doesn't even want to go through the underwriting, maybe this is the way to go.
Certainly the way to go. Certainly for seniors. They don't want to be prodded and prodded and go through the underwriting, have a medical review. They don't want to do that. So you've got the answer.
Well, we're going to talk about single premium life for a couple months here, because we want to start pushing this now, because we think it's the next new market. When we come back from the break, we're going to address the uninsurable, the declinable, the postponed, the heavily rated, everything that's going on in the senior market. And don't forget to enroll in the IULUniversity.com for the best training, education, and support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Welcome to the Brokers Alliance Auction House. I'm Jessica Lopez, and that's Steve Savant. What are you doing?
I'm practicing my auctioneer skills for our carrier bidding process for our producers' substandard cases.
Steve means that we're packaging our substandard cases for underwriters with specific carriers that are known to specialize in certain health impairments.
There are really only a handful of competitive carriers in each category, and we've identified who they are.
It's all about securing the best possible underwriting offer by packaging your substandard case with the right carriers.
So let the bidding begin. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Michael Simpson. And remember, you can order today's giveaway at The Biz at brokersalliance.com. Huge article called MEC Wealth Transfer. We'll talk a little bit about that in a moment. Hey, and just a heads up, before moving forward with anything and the ideas you hear on our show, always consult your tax advisor and your broker-dealer compliance officer. And we're talking about the status, the kind of ideas that go along with single premium. Now, we talked about second to die. We talked about, uninsurable. A person that would be postponed or heavily rated is going to get a break through simplified underwriting on a second die platform. I mean that's kind of, it's not so much that it's unique, it's that I want to reintroduce people into this market, and the flight, I've noticed the flight of annuities producers starting to move, kind of slowly migrating, because the underwriting issues aren't so bad. And
Absolutely.
It's a 3-day issue and
That's
things
right.
of that nature.
That's right. Annuity agents really like to move monies from account A to account B. Simplified issue life, just like that. That's the same sale, single premium. It's the setup, but hey, here's the leveraging. If you don't need the income, don't put it into just an annuity for tax-deferred growth and to protect your principal.
Well,
Consider simplified life.
You had some strategies, though, I thought was kind of unique. You're taking withdrawals to fund some of these single premium to get the tax leverage, because the annuity is great as long as you don't take constructive receipt. But if you start taking income out, or you're passing on to the next generation, we got issues.
That's right, tax
So,
bond.
But you want to do something, because this is a kind of a simple strategy. We all know that most of the good quality annuities all have withdrawal privileges. So if I'm withdrawing, you were saying something, if I remember correctly, you're withdrawing about 10% out of the contract and then putting it into the to an insurance contract, maybe a 10-pay or whatever, to leverage up the tax issue?
A little will do you. So again, if the client doesn't want to take the tax bite, because again, if they come out of the annuity, somebody's got to pay the taxes. And that could be state and federal in some states out there. So what we want to do is take a least invasive attack against repositioning money in a tax efficient way, take a 10% free withdrawal, dump it into an individual or second to die survivorship policy. Simplified issue, again, no fuss, no muss, quick decision. Leverage enough death benefit to offset the remaining taxes that hang on into that qualified or non-qualified annuity.
Now, I'm sure we have a lot of seniors that really don't have what I would call classic estate planning problems. You know, they're below $5 million all day long.
Absolutely.
Individually, $10 million for the unified credit for a married couple. I don't see any issues. But a lot of people want to really transfer to the next generation, sometimes even the generation skip it and go to the grandchildren. They want to be able to push this money out in a tax packaged way, and especially leverage, especially second to die. But I'm wondering, you have these other riders. Those are the death benefit plays. Those are the transfer plays. But besides LTC, like I'm looking at legacy insurance as an example. They have an LTC rider, but they have 3 other riders. I think it was 3 or 4. I think it's a half.
On the individual male, female, they have long-term care, home health care, assisted living, and terminal illness.
Now, give me the difference between home health care and what was the third one?
Assisted living.
Assisted living.
Home health care, obviously, is ideally you're in your own home, your own environment, and you have someone come in and see you part-time on a level to take care of your, what they call custodial care.
Now, how can I legally trigger that if I want to use that in my contract?
Simple. It's in most contracts, but particularly the legacy plan, what you're looking for is the patient had to be, or the client had to be receiving home health care for at least 60 to 90 days. Doctor writes a letter saying they're going to need continual care, and then they could take out 1% per month over a 60-month period, maximum $180,000. Very nice little plan. And again, this is no extra underwriting to qualify for that benefit on the front end.
Now, is that a embedded rider, or is that a rider that actually costs you a certain amount of basis points to attach to the death benefit?
Good question. No additional cost built into the death benefit.
So
And
it's
again,
embedded.
It's embedded.
Wow, that's cool. Now, so I have 4 different riders. What rider do you think out of the 4 is what I would call probably the lead core rider that makes a consumer pay attention?
Of course, long-term care.
It's the lead.
Yeah, it's because they don't want to be a burden to anybody. So that obviously takes that away.
So when I'm thinking about, because a lot of people can't afford a standalone long-term care policy, and if they don't use it, right, they lose it, right? I mean, it's money out the door.
You're renting coverage through a long-term care plan.
So this is kind of a in-between stage. It's not full. It's not like a full-blown contract for LTC, but it kind of gives you. And you said I think it was 60 months period.
That's right.
For in this case, in this one care. Now, when you look at the market, how many players are in this in the single premium life? Do we have 25, 30 in here, or there's only half
about
a dozen?
10 to 11 companies that actually come to mind.
And out of those, are they all offering the basic riders that we're talking about?
They are, but the underwriting is the key. You have to, again, call your broker, call your management, call your compliance officer, and find out for sure, here's the client, here's the sketch, risk analysis, and see if you can get them approved before you even pin an application. Last thing you want to do, take an application, submit it, and then have it an MIB ding against the client.
Oh, no, we don't want that. Some producers have really shifted into the senior market, and they're making the bulk of their practice in this idea of using single premium life with attached morbidity riders, like you said, LTC, assisted home living, things of this nature.
Well, this is considered an annuity replacement type of sale, not necessarily long-term care, because what you're talking about is cash. Clients are looking to position money. They've been doing that for years in annuities, but now we're going to bring them over to a single premium. You're still going to get like the annuity, tax deferred, principal guarantee, avoid probate, access to cash, but ultimately, should they never need it in the living years, it goes income tax free, Steve. That's the kicker. That's what's good for the client, good for the beneficiary, and excellent for the client, for the agent who now can go back to his existing annuity clients and reposition funds. Stop prospecting. Go talk to your current clients.
Stop prospecting. Oh, I thought I had a heart attack, you know. Well, I like that because it's a unique position. This is really a redux of an old idea, only we've completely modernized it for the 21st century. I mean, think about it. Single premium life could be part and an adjunct of your core practice. Remember, you can watch this show and all our shows by clicking on our red button on-demand video right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.